It's never fun to talk about taxes, but when it comes to crypto, waiting until tax season to think about them is one of the biggest mistakes you can make because by then it's often too late to do anything about it. The smartest investors in this space aren't just focused on what coins to buy or when to sell. They're also thinking about how to keep the gains they've made. And that means being proactive, especially while we're still in the same calendar year. So today, I want to walk you through the smartest moves you can make before the 2025 crypto tax deadline. Whether you've made life-changing gains this year or you're just getting started, there are things you can do right now that could save you thousands later. Can't start anywhere but the basics. So in most countries, crypto is taxed as property. That means anytime you sell, trade, or spend your crypto, you could trigger a taxable event. That includes swapping one crypto for another, selling crypto for fiat, or even using crypto to buy goods and services. And if you've received crypto from staking, mining, freelancing, or airdrops, that also could be taxed as income at the time you received it based on fair market value. Now, again, the specifics for all of these situations depend on your specific tax jurisdiction and how they treat crypto. So please contact a tax professional to know exactly what you're responsible for. So what can you do now before the year ends to reduce your tax burden? First, let's talk about tax loss harvesting. If you've sold some coins at a profit this year, you can reduce your overall capital gains by selling other assets at a loss. Let's say you made $20,000, congratulations, in gains by selling Ethereum this summer, but you also have a small altcoin that's down 80% and probably not coming back. If you sell that altcoin before December 31st, you can use that loss to offset part of your gain, bringing down your taxable income. If you're in the US, you can also deduct up to $3,000 in capital losses against ordinary income and carry forward additional losses into future years. You can do this with DEX tokens, NFT projects, or any other crypto that's down significantly. And right now, you have quite an opportunity. The key is to realize the loss before the end of the tax year. If you're still holding it, the loss doesn't count yet. The second move is to review your holding periods. If you've been holding a coin for just under a year and you're thinking about selling, it may be worth waiting a little longer. In many jurisdictions, holding an asset for more than 12 months qualifies it for long-term capital gains tax, which usually is lower than short-term rates. And in some countries like Germany and Portugal, for instance, if you're holding for at least 1 year, it's tax-free. In the US, short-term gains are taxed like regular income, up to 37% for high earners. Long-term gains, on the other hand, are usually taxed at 0, 15, or 20%, depending on your income bracket. So if you bought a position in January and are thinking of selling now, take a look at the exact purchase date. If you're close to the 1 year mark, waiting even a few weeks could make a big difference. Next, let's talk about staking and income tracking. If you've been staking Ethereum, Solana, or another asset, make sure you're tracking those rewards. They're considered income in most jurisdictions and taxed at the value at the time that you receive them. Also, if you're not using a tax tracking tool yet, now's the time to get one set up. Platforms like Coinly, CoinTracker, and Accointing let you connect your wallets and exchanges to automatically calculate gains, losses, and income. If you wait until tax season, these tools can feel overwhelming, but if you start now, you can catch any mistakes while there's still time to correct them. Also, if you've been participating in airdrops, especially ones that launched in 2024, be aware, many tax authorities consider airdrop tokens taxable income. This applies even if the token dumped afterwards. You're taxed on the value at the time you received it, not what it's worth now, which in my opinion is absolutely brutal. But again, this all depends on your specific tax jurisdiction and how they're treating things like airdrops. So again, I highly recommend contacting a tax pro familiar with crypto in your specific area. Another common trap is making gains without setting anything aside for taxes. One trader I heard from made over $90,000 in profits flipping altcoins during the last bull market, but spent most of it assuming more gains would come. The bear market hit fast, and they were left with a huge tax bill and very little left to sell without taking major losses. They had to liquidate blue chip holdings at the worst possible time just to cover the taxes, and you do not want to do that. So the lesson here is simple. Profits are only real if you plan for what they cost, especially when taxes are involved. Another smart move before the deadline is to secure your records. Download CSV files of your trading history from every exchange you've used this year. Save your wallet activity from MetaMask, Ledger Live, or any hot wallet that's seen action. Don't rely on exchanges to hold this data indefinitely, especially if you've used smaller platforms. And one more important move, probably the most important move here, and I've said it a few times already, get professional help if you need it. If you've made serious gains this year, or if your trading activity was complex, think DeFi, NFTs, bridging, staking, you may want to consult a crypto savvy accountant now, not in April. The best advisors get booked out early, and the earlier you start the conversation, the more options you have, and they might have some tricks up their sleeve that will save you on your tax bill down the line. Let's also touch on jurisdictional advantage. If you're considering relocating or spending part of your year in a tax-friendly country, you need to understand the timelines and requirements involved. Countries like Portugal, El Salvador, and Germany offer very favorable tax conditions for long-term holders. Again, if you hold for a year, tax-free, but only under specific circumstances. For example, in Germany, if you hold crypto for over a year, your gains are tax-free when sold, but trading activity or staking can change your tax status quickly. If this is something you're thinking about long-term, now is a time to start doing your research. Changing tax residency isn't just about moving, it's about establishing a footprint. That often means renting or buying property, setting up local banking, and spending a minimum number of days per year in that country. Furthermore, if you're a US citizen, they don't care where else you're a resident. They care if you're a US citizen, you will be taxed forever as a US citizen as long as you are one. So let's summarize the smartest moves you can still make before the 2025 crypto tax deadline. Are you ready? You have your checklist? Harvest your losses, track your income from staking and airdrops, review your holding periods for long-term gains, secure your records across wallets and exchanges, get your tax tool set up now, not later, and if needed, it's probably needed, get help from someone who specializes in crypto. Remember, tax strategy isn't about cheating the system, it's about being informed, proactive, and strategic. You worked hard for your gains. Don't let poor planning take them away. Let me know in the comments, have you started preparing for taxes yet? What's been your biggest headache so far? Or better, what's your best tip? And if you want to learn how to keep more of what you earn, not just through taxes, but through long-term strategy, check out learningcrypto.com. We've got real education for real investors. Thanks for watching. I'll see you in the next video.